Nilotpal. Would be good if you can just drop a text where you're joining from. And also, hello, hi. And also we can get to know, that if we are audible. I'm very well, Yachna. Thank you for asking. Hope you're well too. I am joining today for a change from a slightly chilly, rainy New York. Thank you for yet another session. Yes, we are very excited today. And yes, we are all well. Hope you're too. So as people are joining, if they can just put some text. It's raining in Kolkata. Yes, I'm sure it is. Kolkata rains are famous. I am doing good. Very well. Great to hear, Yachna. And who else is joining? There's, I think we have Vishakha in the waiting room. Okay, now people are joining. Hi, Geeta. Thanks for joining. Where are you joining from?
Hi, good evening. I'm from Bangalore.
Great. Thank you. Welcome. I'm really happy that you also spoke. So audio is all good. Vishakha, I hope you're connected and you can hear us. Also, you can put it in the chat. Great. Okay. We're 2 minutes past. I think it's a little slow today. So we'll, let the people join in as they join and let's get started. So welcome everybody. And just given that we have a few names that we can see. So Vishakha, Yachna, Nilotpal, welcome everybody. We are very excited today because this is our first session with a new partner. And the reason we've picked up the topic of inflation, it's one of the most well-known word in economics. And still, I think a lot of us get confused about it, how it impacts our daily lives. So we have Shilpa Bhaskar Gole from NerdyBird, who's joining us today and is going to be delivering the session on the primer on inflation. And you'll hear a lot about it, how our daily life, where inflation is like everywhere. So as always, when we start, we do a couple of icebreaker questions to get a feel of the team, how you are on the subject, how you feel about it. So I will request Tanvi to start with our icebreaker questions, and we'll follow it up with our pre-session poll question before we hand over to Shilpa. Over to you, Tanvi.
Thanks, Simran. Hi, everyone. Good evening. Thanks for tuning in. So today we're going to talk and get to know a little more about inflation. So before we actually get into the details of the session, the few icebreakers questions I have are, first, I think you can use the chat box to kind of give your responses. What comes to your mind when you first hear the word inflation? I'm sure it's a very common word that you've heard around us a lot, but what really comes to your mind when you first hear about the term inflation? What does it mean to you? You may type in your responses in the chat box. Okay, Simran says price rises. Anyone else wants to give it a shot? Geeta, Nilotpal, an inflating balloon. Very interesting visual that created. Expensive. Cost of money goes down over time. Yes, I think it's a little convoluted concept, but right about on point. Great. I think we do have some sense of what inflation is. Disparity between costs versus earnings. Low interest rates, fascinating. Rising expenses and costs. Yeah, I think Shilpa is the expert here. I will let her do the talking in a few minutes. Thanks for responding to that, engaging with that question. Now on to the other question we have is, are you aware of the current inflation rate? So I'm assuming all of you are tuning in from India. So given the Indian context, do we know what the inflation rate is currently for the current fiscal year? Okay.
Would you like us to state the inflation rate as well?
Yes, absolutely. 6%, 10%. Any more guesses? Or if you know the answer? Okay, I think I will let Shilpa unravel that for you in a few minutes. Thanks for engaging with us on this icebreaker questions. And with that, I think are we shooting the poll questions next, Simran? Okay, great. Over to you then.
Harisha, would you like to bring the poll question on the screen, please? Thank you. Yeah, I think we have it from 4 participants, and they're all new to the topic and would like to learn more. Excellent. Thank you, Farisha. I think we can close the poll. And with that, we hand over to you, Shilpa. And once again, welcome to Aspire for Her, She Knows Money tribe.
Thank you so much, Simran, for the warm welcome. It is a pleasure to be here with the Aspire for Her community. And this really aligns with what we at NerdyBird do day in and day out. So I'm very excited for our future collaborations as well as this one. And with that, I'm going to start sharing my screen. Right, so I hope all of you are seeing this on your screen. And if you are, just give me a thumbs up in the chat box.
Yeah, we can see your screen.
All right. So welcome to this session on the primer on inflation. And let me start by giving you a little bit of information about us. So at NerdyBird, it is our vision to see women around the world feeling confident with money. So we're here to help you and partner with you to help you find your financial confidence. And how we do that is by helping you get aware of what your financial goals are, what your relationship with money is, what your beliefs around money are, and then helping you move from that position to knowing where you are currently with your money. You know, how much do you have in terms of your assets, your liabilities, and then getting into planning mode. So we help you plan action around money, around each of your financial goals, and then nudge you to get started. So we believe that it's important to also help you get into action. So as financial coaches at NerdyBird, we work with you right from planning and awareness to the phase of action with money. So whether it is your investing, whether it's insurance, whether it is your tax planning, we are here to partner with you on your journey and help you get confident with money. So you could always visit us on nerdybird.in to know more about what we do or book a 15-minute call with us. So let's jump into the topic. And before that, let me just tell you a little bit about myself. So I'm India's first certified financial fitness coach. So what that means is that I not only help with understanding the technicalities around personal finance, but I also understand that money is very strongly integrated and ingrained with life. And every decision we take around money has some kind of a life implication, right? So from that perspective, I work on the intersection of life coaching and financial planning. And how we do that is that we do a lot of deep work with our clients and work from a space of being very non-judgmental and confidential and help them fully feel vulnerable and express their full selves when it comes to money. And that's how we help them unlock their potential and start to really build that abundance into their life when it comes to everything finance. So moving to today's outline, today we're going to be talking about, we're going to do a little bit of a deep dive into inflation. So while this is a primer, we are going to look at how you view all your financial goals from from an inflation lens. and see how you can start to build that and account for it in every decision you take in your daily life. So we're going to start by looking at the rising prices in our daily life, what inflation really means if we had to go a little into the technicalities of it, and then move into understanding inflation rates of all the things we use in our daily life, be it goods, be it services, and then understand if there's also a compounding effect around inflation. We keep hearing about the magic of compounding, but is there also another side, the dark side to the compounding effect? So we're going to look at that today as well. And finally, talk about strategies to help you keep up with inflation, to beat inflation, to one up inflation. So let's get started with rising prices in our daily life. I want to start by narrating a story to you about this famous dish in Rajasthan called the kachori. So, you have this way with elderly people where they sit with you and like to narrate stories about how things are getting so expensive these days, right? I mean, we've all seen that in our lives where people will tell us, oh, there was this time in our life where something cost just, 1 paisa or 2 paisa or even annas for that matter. And today we're talking in terms of, thousands of rupees. So there was someone who told me, this elderly gentleman told me once that in 1966, a kachori cost just 10 paise. And today, in 2022, not today, in 2022, when I met him, he said that the price today is 20 rupees. So if you had to just tell me, how many times higher is the price? Can someone just put it out in the chat box to tell me 10 paisa in 66 and in 2022, 20 rupees? By, how many times has this price multiplied? What is the kind of magnification effect we're seeing here? So can someone just put it down in the chat box for me? 200 times, Nirotpal. Absolutely. Correct. You're bang on target. So the price of the Kota Kachori has increased 200 times in the last 56 years. So what does that really mean for us? So then I dug a little deeper to see, how did this happen on a year-on-year basis? Did it slowly creep in or one fine day, 200 times the price? So what I understood is that the price rise of every item happens very slowly. It just sort of creeps in on us without us even noticing it. So with the Kota Kachori, for example, the price increased by 10% every year. So if it was 10 paise, then it went up by 10% and another percent. And one fine day in 2022, the price of a good kachori is 20 rupees. So I would now like to invite you to share an example from your life where you have seen prices increasing. No? So please share something that you have noticed lately of some item that is very dear to you, maybe that you like to buy very often, that is now very costly. So could you just share in the chat box what was the previous price? What is it today, if you have any idea? You don't have to be accurate, but just an estimation of any item in your life. You can unmute and speak, or you can share it in the chat box.
So
Nilotpal,
I'll
do you want
say,
to? Yeah, go ahead.
so to me, I think I don't know if they're dear to me, but to me, like the daily life, the usual stuff I observe, the groceries and the same items that I've been buying for years suddenly feel, especially in current times, also because of the current global situation, they feel like 30% more expensive. And just about 2 weeks ago, similar amount of weekly stuff that I bought, and when I paid, that made me really reflect, because I think I literally paid 2.5 times more than what I've been paying before, and it's just been increasing slowly. The little increases I observed and I didn't think about it, but a couple of weeks ago when I paid, that's the first time I reflected. I'm like, wow, that's such a big difference in a very short time.
Yeah,
this is just daily, regular staple things that we all buy.
Yeah, and Yajna says, even the pulses and food. Yes, absolutely.
Correct.
Geeta, my God, 5 rupees to 50 rupees for a loaf of bread. Absolutely. And Tanvi says the price hasn't risen, but the quantity has decreased in a Lay's packet. Absolutely. And I'm also going to share a very similar example of, one of these items that I really love to eat, and how much that has decreased by. So I'm still paying the same price, but the item is now, from being the size of 50 grams has come down to like 5 grams for a packet. So yeah, that's rather unfortunate. So like you all rightly shared, I think right from pulses to food, to our bread, to the school education of our kids, to the fuel prices, to all our grocery items and everything we use on a day-to-day basis get expensive year on year with time. So what is inflation then, really? So inflation is essentially the speed at which this price rise is happening. So it's the rate at which the price rise is happening. So if you notice in the chat box earlier, when someone asked, what is inflation? I said it's like an inflating balloon. So imagine if me and Simran were standing together and we were both given balloons and told that you have 10 seconds to start. So the timer starts now, and in 10 seconds, you blow the balloon. And my balloon grew bigger than Simran's. So in 10 seconds. So basically what happened is that I was just inflating it at a speed faster than Simran's balloon. So it's essentially just the rate of price rise or a speed. So when it comes to inflation, when inflation falls, the prices continue to go up, but at a slower rate. So it's only like measuring a speed. We're moving forward, but it's just the rate is slower. Most cases, you will find that deflation, which is the opposite of inflation, doesn't happen in an economy like ours, which is growing, and we need a healthy growth of inflation. So in an economy like India, where we are an emerging economy and we need growth to happen, there will always be a little bit of inflation. And there will be times like in the last couple of years where we see high inflationary environments. Now, what are the primary causes of inflation? Now, there are many, many causes, and I'm just going to talk about two of the very primary reasons why inflation happens. So one is what we call demand pull, and the other is what we call cost push. So let me spend a couple of minutes explaining what these two concepts mean. So I don't know if you've noticed this, but when there is a low supply of an item in the market, you'll notice that there is a higher demand and the price of that item goes up. And vice versa. When there's a large supply of a certain item in the market, the prices go down. Can someone share an example from your life where you have seen, that there is a certain item which is in short supply and therefore the prices go up? I would say most recently when COVID happened and there was this shortage of, food supplies for us in the first 3 months of COVID, I remember that, even the most basic things like my milk and the vegetables that I eat, the prices just skyrocketed because there was a supply disruption. There weren't enough of those products going around, and all of us wanted them. So the prices really shot up during that period. So I'll be happy to hear from you of any examples. Has anyone noticed it with mangoes? Because the season just started and there's a huge demand for mangoes because we all want to be eating it from the beginning of the season. But when the season just starts, mangoes are in short supply. It takes a little time for it to, increase momentum in terms of supply. So, any ideas and any experiences from your life where you have seen that there's a certain item which is short in demand, short in supply, and therefore the prices go up? Shortage of health products like vitamin tablets. Absolutely. Yeah, I think during COVID, we saw a lot of examples of demand pull. Yeah. Oxygen cylinders as well. Onion prices have gone up as well. Absolutely. And down. Yes. And another form is cost push, where the cost of producing, goods and services go up. Now, this often happens because the supply of certain items are not available in the market readily, or their prices go up. The raw materials needed to produce these goods and services. A very, pertinent example to today's scenario is that with the Ukraine war, we are seeing a huge disruption in fuel and food supplies. So Ukraine, as you know, is a country where a lot of food grains are produced like wheat. And when their, war broke out, there was suddenly a disruption in the supply of wheat and other food grains across the world. And that led to a cost push because a lot of places where, these raw materials in terms of food grains were important for processing, there was a disruption in the supply. And similarly, we find even with oil, with your diesel and your petrol and all other fuels, because oil is something that we import as a country, there was an issue even with oil because oil is a raw material that we use in so many different manufacturing units in our country. So suddenly a lot of goods and services that required, oil prices to be low, for the prices of the goods produced to be low, suddenly those products just went up. And that's something that we are also continuing to struggle with because in April 2022, the inflation rate went up to 7.8% as per the consumer price index. So if you were to look at the consumer price index of India, which is a measure of India's inflation, our retail inflation, what had happened is that in April 2022, the prices went up to 7.8%. Now, is that an indicator or not? We'll talk about that later, but relative to how the CPI had been historically, it's historically always been in the range of 5 to 6% or hovering around 6%. Suddenly, we're seeing it go above 7% and above 7.5% for that matter. So then the government went all out to help us control inflation and bring down the cost of products. And we'll talk about that a little more a bit later. But for now, it's important to understand what are the primary causes of what we see happening with all the stuff that we use and buy. Right. So I was talking about a product that is very, very dear to my heart, and no points for guessing which brand this is of chocolate that I'm talking about. But 15 years ago, I remember buying a bar of 50 grams for 10 rupees. And today for that same 50 grams, I'm paying 50 bucks. And in fact, even more, I'm paying 70 rupees for a 50-gram bar. And that really breaks my heart. So what I want to also talk to you about is now what happens in high inflation environment if you have a 100 rupee note sitting in your drawer. So say we are in 2020 and you had this 100 rupee note which you left sitting in your drawer. Forget demonetization for a moment. That note is in your drawer. 5 years later, you discover it and decide to buy something with it. What's going to happen for you? Can someone share in the chat box? Tanvi shares that energy and electricity are getting expensive in Europe. Absolutely, because of the war. So any thoughts on what will happen to a 100 rupee note sitting in your drawer 5 years from now? First of all, if someone can share what a 100 rupee note can buy them today. What can you buy with 100 rupees today? For me, it's 10 bars of little 5-gram chocolates. Yajna, what can 100 rupees buy you? Nilothal can buy groceries for a day now with 100 rupees. Okay. At the current rate, it will be worth 60 or 70 rupees. Absolutely. So Nilotpal, what would happen? So you can buy groceries today for a day now. And what will happen, say, 5 years from now with that same 100 rupee note for you? So what Simran very rightly said, the time value of money decreases. Okay, absolutely. The value will decrease to that of 50 rupees. Maybe I would buy a kachori. Absolutely, Nilotpal. So the value will decrease to that of 50 rupees. Okay. Yeah. So we don't know, we can approximate, what the value will be of that 100 rupee note, but essentially it can't buy you 100 rupees worth of stuff 5 years from now. It can buy you maybe 60, 70, or even 50 rupees worth of products. So when Nilotpal goes to the grocery store again to buy a day's worth of stuff, he may not even get half a day's worth of stuff from it and maybe just buy that kachori. So that brings us to the question of what happens to idle money vis-a-vis invested money. So for a moment, I want you to think about not just the money in your drawer, but also the money that may be lying in a locker or maybe lying in your wallet or in your cupboard for that matter, stashed under some clothes. A lot of us tend to hoard money at home or even in a bank account with a low interest rate for that matter. What happens to that money sitting there? I think like you all rightly said, the purchasing power of that money goes down. So vis-a-vis something that is lying in an investment and is growing for you year on year and is compounding and helping you stay afloat with inflation. Now let's come to how inflation is measured. Now that we know what inflation is and the fact that it reduces your purchasing power over time, it's important to see how we should be measuring inflation in the first place. Now, if you look at how inflation is measured, it is measured in India by two key indicators. One is the consumer price index and the other is the wholesale price index. And for us, as retail users, it's important for us to look at the consumer price index. Both of these indices track the prices of goods and services. One of them looks at it from a retail point of view, that is us going to the shop and buying the product, whereas wholesale looks at it as us going and buying something in bulk. So that would be more, for people who are buying things in bulk, would be, industries that are buying raw materials in bulk, and shops and, wholesalers and traders that are buying material in bulk. For us, essentially, we look at the consumer price index because it gives us a closer reference to the prices of goods and services we use. Now, what is the CPI really? So what government has done is it's created a consumption basket. So it's decided that let's take a bunch of goods, a basket of goods and services that an average Indian typically uses, and let's measure how the price of those goods increases over time. So what they did is, depending on how important or how much money, so say we have 100 rupees in a year, out of 100 rupees, they've given weightage to each of these goods and services. So they say that out of 100 rupees, people may be spending 40% on food. So they have actually allocated 40% to food, vis-a-vis education, which they've allocated probably just 3 or 4% to. So different goods and services in that basket have a different weightage depending on what part of our money goes towards that expense. Now, do we really look at CPI for us is the big question. Now, it is an indicator and probably the only indicator we have right now, but essentially doesn't appropriately represent what you spend your money on. And why is that? Because the people in this conversation and those of us who are in the room right now, we don't really come into the category of the average Indian. The average Indian would be only earning a lower income than we are, and we fall into a slightly higher income bracket. Now, having said that, if you look at our expenditure on food, so someone in a lower income bracket would be spending around 40% of their income on food, vis-a-vis us who spend around 5 to 10% of our income on food. And if you look at education, it's the other way around. The weightage is only 4 or 5% in the CPI, vis-a-vis us who send our children to very good schools and end up spending on their co-curricular and extracurricular activities, their books, and all the other peripherals that go with an education in urban India. And this may go up to even 10% of the income that we are spending in a year. So that brings us to the important question then. If you're not going to look at the CPI as a measure of inflation, what do we do then? Then I think it's important for all of us to sit down and look at all the stuff that we spend money on and see what the inflation rates for those items are. And if we had to do a little introspection there, you'll notice that each of these items, whether it's your vegetables and fruits, whether it is that home you want to buy, or the car you want to buy, or the fuel that you spend on every year, or your college education for your children, or health expenditure for that matter, or an air travel and a holiday somewhere, all of this costs and inflates at a different rate. So there are certain items here that inflate at a rate slower than certain other items. And I'd like you to just type out in the chat box and tell me which one of these goods and services mentioned here inflates at the highest rate per year currently, if you had to just think of the current terms. Fuel, okay. Simran says fuel too. Daily need groceries. Medical expenses, okay. So
if I may, Shilpa, I think it's a little bit correlated as well, right? Like fuel increases, that drives the price of the groceries because of the delivery that you use, then that drives the price increase of the, travel as well. Fuel prices increase. That drives the cost of living in our houses. If you're using fuel for electricity, not everybody today is using solar energy. And honestly, solar energy has quite a high startup cost.
Absolutely.
It takes a few years before it, gives you the return on investment.
Yeah.
So it's a little bit all correlated, isn't it? I guess.
Absolutely. A lot of items are, yes. So like we had talked about in the cost push inflation bit, like if there's a supply disruption in oil supply in India, then a lot of raw materials that depend on oil for their production their prices go up too. So similarly, like you rightly said, if fuel prices are high, it definitely means something for the fruits and vegetables too, because the transportation of those fruits and vegetables to our doorstep, to our retailers nearby, all of that costs. And that if those prices go up, the prices of the final product goes up as well. So if I had to look at this entire list and just say from what data says currently, health expenditure is at its peak. So in Asia, currently, India is the country which has the highest level of health related inflation, and it is at 14% per year currently. And education as well is at 10%. Now, with fuel, it's very, very volatile. There are years where we see like a 3 to 5% increase, and there are years where we're seeing 10 and 12% increase. And it suddenly hits us one fine day. So there's a lot of price sensitivity there for us. With college, there's a lot of predictability because we're told that every year we're going to hike the prices by 10%. With health expenditure in the last year, so in 2022, the survey came out and it showed that in all the Asian countries, India is at 14% inflation per year for health. Which brings me to the compounding effect of inflation. So assuming that you had, you were looking at inflation at 10% per year for hypothetical, an example, and we looked at compounding growth versus simple growth. So if I had to assume that 100 rupees is what I start with in terms of the item, and 100 rupees were to grow every year to a simple rate of just 100 into 10%, then I'm looking at 190 rupees in the 10th year, vis-a-vis a compounded growth where it actually magnifies to 236 rupees. So what is happening here is similar to the magic of compounding that you see in investments. The dark side of compounding is that the 100 rupees that you have is also going to see a compounding base effect when it comes to inflation. So if you're starting with 100 rupees becomes 110 in year 2, and in year 3 it becomes 121, and then 133, and then it just starts to multiply. And by year 10, we're looking at 236 rupees. So it's important for us to also take cognizance of this while we are making decisions around our investing and earning and everything else that it comes to when you talk about inflation and your life. So if I had to show this to you graphically, you will see that as if you had higher inflation rates than 10%, then this gap would be even higher with time. But basically what happens is that there's a magnifying effect because there is inflation and inflation over inflation and inflation over that. And we start to see the compounding dark side of inflation. So let's talk about now, how can you really be one up on inflation? And we're going to look at this from different lenses of financial action that you could be taking in your personal lives. I think it's important for us to first look at what are all the needs, wants, and desires that we have. And if we had to put them in a timeline, where would it fit in? So this is an indicative list I've put down here. For all of us, the priorities would be different, the timelines would be different, but to just give you an idea of what this could look like for you, you would have certain recurring expenses that you're going to see for your entire lifetime. And those are your basic needs, your lifestyle needs and wants, your luxury needs and wants, recurring goals such as paying your insurance premiums, apart from all of the other basic needs like paying your electricity bill, like ensuring that your rent is paid on time, and your groceries. So there are certain variable expenses and there are certain fixed expenses, but all of this happens year on year. There are also certain short-term goals that you may have, like educating your children every year. So the school fees has to be paid up twice a year, maybe 4 times a year. And you may also have certain dreams about traveling abroad, and you may be saving up towards that in the next 2 to 3 years. There may be certain medium-term goals. You may have decided that you want to buy a house in the next 3 to 5 years, maybe 5 years, 6 years, and you need to save up for the down payment of the house. There may be a car in the offing too. And there may be certain long-term goals that are more than 10 years away, for which you also need to start thinking about, like your kids' college education fund, your child's marriage fund, possibly, and also your own old age security or your retirement. So how do we look at inflation from the lens of each of these financial goals that are important to us? If we had to look at what are the kind of investments that we can look at and explore, if we had to think about this time horizon, essentially you have your 0 to 3 year timeline, You have a medium term timeline, which is around 4 to 10 years. And you have the above 10-year timeline, which is, which could be for your long term goals. So if you had to look at risk and returns and then think of where you want to park your money for these goals, then these are, your most fundamental investments that you could be making towards these goals. So let me take a couple of minutes to just explain what these two investments are. So we're looking at debt and we're looking at equity. When we say debt, we're talking about growing our money by lending our money to an entity or to a person. So when you're lending your money, you're lending it to a bank in the form of term deposits, in the form of a provident fund. You're also lending your money to corporates in the form of corporate bonds. You're lending money to the government in the form of bonds, into the government bonds and RBI bonds. And in this form, you start to earn an interest income or a fixed income. So it's also known as a fixed income investment. And there may also be some short-term, very, very short-term investments that you need to make, like for your emergency fund, which you park in a liquid fund. So these are very low-risk instruments. And because they are of such a low-risk category, they also come with lower returns relative to your market-linked returns. And then you have stuff which is in your long-term category, which is basically equity. So equity in the form of stocks, equity through the National Pension Scheme, which also puts your money in stocks, equity mutual funds, and ESOPs if your organization offers those to you. So if you had to think about your goals, you would be mapping your investments into some of these debt instruments, some of these equity instruments, and you'd also be diversifying into gold and into real estate. So if you had to look at inflation from various standpoints, you're going to be exploring strategies around earning, around repaying your loans, around saving and investing for your future goals, paying your insurance premiums, spending on your current needs and wants, giving if that's on your goals as well, paying your taxes, and then reviewing progress on all your goals in your action plan. So before we do anything else, the first strategy that you need to have in place is your cash outgo plan. So what are you going to do about, I'm sorry, just give me a moment. I'm having an issue with my, fine now. So let's look at your cash outgo plan first. In your cash outgo plan, it's essential to design the plan, design a budget for yourself based on the lifestyle that you desire to lead and compare it with your actual outgo. That's when you'll be able to introspect a little more about what are the expenses that you want to continue, which ones do you want to reduce or see completely disappear from your lifestyle, which are some of the new ones that will get added, and include needs, wants, loan repayments, outgo for investments, outgo for insurance premiums, your gifts, your donations, and your taxes. Once you've done this exercise, it's important to also look at your risk protection and see whether you're hedging against inflation also in terms of your risk protection. So like we discussed earlier, your health insurance and inflation is the first bit to look at, because if health expenses are rising at the rate of 14% per annum, it's important to also step up your insurance cover for health insurance regularly. I'm sure in some of the previous sessions with Aspire for Her and She Knows Money, they have explored protecting your money from risks through health insurance, having an emergency fund, and life insurance. So the first and most fundamental thing to look at in your cash outgo plan is whether you are accounting for an increase in your health insurance premiums in every few years. The second important bit around creating this foundation for yourself and having this protection in place is your emergency fund. Is your emergency fund keeping up with inflation? Now, this is a less discussed subject because people tell you to, start your emergency fund, park this money in low risk, low return instruments which are liquid, and put this, make sure that you at least have 6 months of expenses in your emergency fund. But nobody talks about topping up your fund every year. What we all need to understand is 6 months of expenses in this year is not going to be what the expenses look like in the next year. So are we ensuring that we're topping up the fund every year? Now, how can we do that? I think it's important for us here to look at short-term and medium-term goals from a very similar standpoint. So what we're saying here is that if any of your goals are short or medium term and require the money to be parked in low risk instruments to medium risk instruments, you will be earning a rate of return that is lower than inflation. So whether it's your emergency fund or anything else that you want to be doing in short term or medium term, you will have to step up your savings rate there to ensure that you keep up with inflation. because the returns will always be lower than the inflation rate. So if you just take the example of a term deposit, your fixed deposit or a bond for that matter, which is giving you anything in the range of 6.5 to 7% return, if you had to look at the post-tax rate of return, it'll give you around 4.5 to 5%. And inflation for a goal is say 8%, then we're looking at 8% minus 5%. So there's a 3% gap that will always be there. So by 3%, your money will lose its purchasing power every year unless you keep stepping up your corpus by that amount. So for your emergency fund, for example, if you have 100 rupees in your fund, step it up by 3 rupees next year. It's already parked in an instrument giving you a 5% return. But just to stay, abreast with inflation, make sure that you are putting in that extra 3% or 4% every year. Now let's come to our long-term goals. For our long-term goals, the inflation risk is much higher because we're looking at a 20-year horizon, we're looking like at a 30-year horizon, and over that period, your money is bound to lose its purchasing power unless we park it in inflation-beating instruments. So here it's very important that we diversify our investments across high risk, high return instruments depending on our own risk tolerance and our risk-taking capacity. And what would happen here is that you would be earning a rate that is either at par with inflation or higher than inflation. Now, why I say at par is because I'll just give you an example of an equity index fund. So if you park your money in an equity index fund today, which is giving you a return of anywhere between 10.5 to 11%, not more. Even after we remove the capital gains, the tax rate of 10%, you'll get around 9 to 10% from your investment. And inflation is still around, say, 8%, maybe more, maybe even at 10% for an education goal, for example. Then you're just ensuring that your money is staying at par with inflation. And I also wanted to give you a quick view at what the Nifty 50 index looks like. So this is an old screenshot where I've looked at how it looks like in 1 month where there's no clear trend emerging, and how over time, if we look at the Nifty 50 index, for example, to just give you a sense of how the equity markets are, there is a lot of volatility in the short term. But if we look at it in the long term, we are bound to see above inflation returns if we hold it for 10 years and longer. So for your long-term goals, look at diversifying across asset classes. As someone mentioned earlier on in the chat box, interest rates also vary when the government tries to control inflation. So now when the inflation is really high, the government is trying to control it by increasing interest rates. So suddenly we're now seeing very high rates in our debt asset class. So we're suddenly seeing 7% interest rate and 6.9% in our fixed deposits and our bonds, which we hadn't seen in the last 4-5 years, vis-a-vis an equity which has kind of slowed down in the last 2-3 years. So to be able to reap the benefits of your investments and make sure that you're beating inflation over time, it's very important to diversify across asset classes. And one of the most important pieces here is also gold. So gold is a hedge against inflation. So while we're not talking about physical gold here, but if you could hold, say, around 10%, not more than 10% of your assets in gold, that will ensure that in high inflationary environments, especially when there are global supply chain disruptions, you will be seeing better returns from gold, and that will help you stay afloat with inflation. It's also important to diversify across sectors, across different financial institutions, so not holding money within one fund house, making sure if you're looking at equity, you're diversifying across different fund houses. That will also help you stay diversified. And of course, across geographies. So I think one of the important pieces here is that there are currencies that are stronger than us. So how can we invest in global equity markets and global currencies to ensure that our currency, whatever money we have, is staying strong? Because the Indian rupee is a weak currency. So it's very important that this could also be a hedge for you against inflation. Finally, I'll come to the retirement goal and then we'll wind up. I think this is a piece which is very, very important from an inflation standpoint. For a moment, I'd invite you to, in your head, look at this timeline. Imagine for a moment that you're earning for 30 years of your life, say from 30 to 60. And from 60, you decide that, hey, I will continue to earn, but I am hoping to be completely financially free by then from 60 to 90. So I'm hoping that I have a corpus big enough for me to live off for the next 30 years. So if you wrap your head around this, you'll notice that 30 years of earning vis-a-vis 30 years of spending the funds that you have invested, which is a pretty long time. And if you had to go deeper and just think about how much you spend today. So say you're 30 and you're earning, say, 12 lakhs to 14 lakhs per annum, and your expenditure, say 10 lakhs per annum. Let's go with an example of 10 lakhs. 10 lakhs, if it had to inflate at 8% per year, what would that be in 30 years' time? Any guesses? So say your spending is 10 lakhs and you want to be able to spend 10 lakhs in your retirement as well. So, you start saving money for it. I'm just curious to know if any of you have an idea what the value of your 10 lakhs that you spend in a year would be in your first year of retirement. You can take a wild guess. We're looking at a 30-year horizon and 8% inflation as an assumption. Okay, so I'm going to answer this. 10 lakhs would have magnified 10 times. So your 10 lakhs would be 1 crore. So on all the stuff that you are spending on today and you're living the lifestyle that you want in 10 lakh rupees, the same lifestyle would require 1 crore in 30 years, starting the year one. So year one, 1 crore. What would happen after that? What happened after that is, so if you just look at this timeline, retirement year one, RY1, you spend 1 crore. Retirement year two, you would spend 1 crore plus inflation. And then year three, again, there would be inflation added to that. So essentially, you need a corpus that is big enough and that continues to grow at a good rate per year. And at the same time, you're able to draw money, inflation adjusted money every year from that corpus. Now, a lot of people will tell you that, in that case, why don't you just have a retirement corpus that, you preserve the principal and you're just living off the interest every year. Now, there's a problem with that. Say, for example, you start with a corpus of 100 rupees, just for simplicity. And in the first year, your 100 rupees earns, say, 10 rupees. So it becomes 110. And you withdraw just 4% of that money for your year one expenditure. What's going to happen is year on year, that 4% that you withdraw will not be 4% in the next year. The next year, you're going to withdraw 4% plus inflation. And then again, inflation added to that. So eventually, if you had to look at it theoretically, your corpus will run out. And which is why we build in safety nets into our retirement calculations to ensure that we don't run out of money in the lifetime that we have. So we ensure that we're taking at least 30 to 40 years of lifespan post-retirement. We try to delay the retirement period, and we also work this out with different inflation rates to see what is the minimum that I need to be saving up and what's the maximum I need to just ensure that I have that safety net through my retirement. And finally, what's important now, and that sort of ties all of this together, is that once you have your cash outgo plan in place, which talks about your expenses, your needs and wants, as well as your SIPs every year, as well as your insurance premiums, your giving, your taxes, all of that put together, do you have an earning strategy in mind? And can you ensure with your cash outgo? I know that this is easier said than done, but I'd just like to share a few ideas here. And I'd love to hear in the chat box if you have any ideas of how you want to tackle inflation over time through the earning side. So one is about stepping up our income at regular intervals. So are we asking for a raise? Are we ensuring that whatever company we are working at is including a raise every year that is indexed to inflation? Is there an additional source of income that you can create for yourself to also help you, keep up or stay afloat above inflation? And or some of us also look at changes in jobs to ensure that we're able to meet that kind of every few years we step up our income by looking at new avenues and new employment. Is upskilling something that you are also exploring to ensure that you're able to keep up your earning capacity over time? Another important piece as women for us to think about is learning the skill of negotiating what you believe you deserve. And I bring this up from the wellness coach point of view because I've noticed in my area of work that a lot of women struggle to negotiate higher packages for themselves in their workplace. And we all know about the gender pay gap, and how important it is for us to be able to demand our worth and our value in the work that we do. So, are you building those skills as well to be able to negotiate better pays, better business income for yourself in whatever area that you work? And all of this also ties into having and nurturing a mindset that welcomes more money into your life. Often, a lot of us come from this limiting belief that having too much money makes me greedy, or I am bad with money, or other beliefs that sort of hold us back from welcoming more money into our life. So, what can you do to change your mindset or to rewire your mindset to be able to be more welcoming to money? And finally, I just want to leave you with a little piece which is more of an addendum to our entire conversation, which is around the tax implication of investing, of inflation. So it is important for us to note that the government this year in their budget has removed this indexation benefit that they offer on a lot of assets when it comes to taxation. So what this basically means is that if something cost you 100 rupees and you bought it for 100 rupees, and today the value of that item is 115 rupees, what the government says is that you don't have to pay tax on 115 minus 100, but rather what is that 100 rupees in today's value if you had to index it with inflation? So you build in the inflation and say that brings you to 108 rupees, right? So then 108, 115 minus 108, 7 rupees. So you're not paying the entire capital gain of 115 minus 100 or 15 rupees, but rather you're paying it on just 7 rupees of capital gains. So wherever you can, and based on whatever investments you have, look at where all you can avail the indexation benefit to be able to reduce your taxable income through the capital gains category. So here, mutual funds where equity allocation is between 35 to 65%, those kind of funds, yes, you can avail the indexation benefit. Gold and gold ETFs, sovereign gold bonds, if you sell them in the market before maturity. Of course, sovereign gold bonds, if you sell them at maturity, it comes completely tax-free. Unlisted shares, if you're investing in private equity. And finally, real estate continues to have the indexation benefit. We don't know how long further the government would keep these benefits, because they're simplifying the tax rate system, reducing taxes and making them simpler for us. But at the same time, they are reducing some of these, added benefits that come with indexation. Finally, what are the newspapers talking about when it comes to inflation? So here are some of the key words for you to watch out for when you're reading the newspapers on, whether it's your Economic Times or the Mint or any other, or the Prime Investor or any online media houses that you follow when it comes to financial news. So one important piece is to keep looking at the current consumer price index. So all of you typed out the current, value that it is, but today the CPI is at 5.44. So April 2022, 7.8, 7.79%, and they brought it down to 5.44%. So though it may not have an immediate or a direct sort of impact on us, because a lot of our food basket looks different and our consumption basket looks different, but there is still a little bit of effect that this would have on us. So it's important to keep track of what the CPI is currently. What are all the factors that are affecting inflation? So we know that the high rates of inflation last year were because of the war in Ukraine that caused supply chain disruptions in oil and as well as food. So keep looking at what those things are. What is affecting inflation? Now, for example, the monsoons are coming up. So if we have a good monsoon, that would also improve the purchasing power of farmers, and which make up the majority of us in India. So that would lead to more income in people's hand, and therefore better, a slightly higher inflation possibly vis-a-vis, but it will also lead to a higher supply of agricultural produce. So we don't really know how that would go. And finally, we can also look at the monetary policy stance. So there is a monetary policy committee in the Reserve Bank of India, which tries to control inflation by adjusting interest rates. So the repo rate is the rate at which the Reserve Bank of India lends money to different banks. So if that rate is higher, chances are that people will not want to spend money or take loans. So the moment the banks are taking loans, there is more money supply in the market. And if the interest rates are higher, the chances are that the banks will be disincentivized from taking loans. So the incentive will not be there to be borrowing money, and therefore it would reduce the supply of money in the market. So that would be one way to keep inflation in check. Cash reserve ratio is a related topic and a related indicator where basically the government is taking back cash. So the RBI is taking back cash and increasing the reserves of banks and the Reserve Bank by increasing inflation rates. So by increasing interest rates. So when the interest rate increases, essentially people are disincentivized from borrowing, which means they park more money in deposits and in various savings instruments. So that's how the cash reserve ratio of banks go up, and there's less money supply in the market. So when there's less money supply, chances are that the monetary policy has made the cash reserve ratios go up, and therefore you're seeing less money in the markets. Another two terms that you would possibly hear, one is core inflation and one is headline inflation. And here are what they're about. So the core inflation is inflation related to commodities, goods and services, but minus certain volatile food and fuel prices. Whereas headline inflation is the CPI, which covers all the commodities in the market. And with that, it brings us to an end of our session today. So we spoke about rising prices in our everyday life, what inflation really is, and what is the inflation rate of all our financial goals, all our goods and services that we consume, the compounding effect of inflation, and how to be one up on inflation in your financial planning goals. I have already shared a bit about us in the earlier slides. This is a little bit about our approach. And with that, I'm going to leave it for reflections. Should I stop sharing the PPT, Simran?
Yes, I mean, it's okay if it's here, and if you want to stop sharing, that's also fine. So thank you so much, Shilpa. We have about 3 minutes left. I think we can use about a minute if people have any questions, they want to unmute themselves and ask to Shilpa. And at the same time, Shilpa is going to be back with us. There's a quite an extensive plan that we're working with her to continue giving us these sessions. Anybody has a question here before we launch our closing poll?
So Nilotpal wants to know if the issue of inflation will go down if we emphasize on growing homegrown products and entrepreneurship.
I answered that.
Yeah. Oh, you
Please
did?
go ahead.
Okay. Sure. Yeah, not entirely. I think Simran's absolutely right. A little bit of inflation is very important for a healthy growth rate, Nilotpal, in the economy. And I think what will happen, even if we have entrepreneurship and homegrown products, if it does increase the money in our hands, that does mean that we have a higher spending capacity, which would always mean that increases demand, right? So if we all have more money in our hands, that increases demand, and there'll always be the demand sort of controlling what the prices look like. So higher demand does lead to higher prices, so which is healthy for an economy like ours. Of course, it shouldn't go out of hand. So if supply chain disruptions are in place, I think we can keep inflation under control and at a very healthy level, so to speak.
Great. So I suggest we, I think maybe there's more. Oh, yes, understood, clear. Thank you, Nilotpal. Excellent. I think let's launch our closing poll and see how the participants feel after the session. Do you think this session has helped you understand the concept of inflation? Oh, I hope so. Definitely some new things brought to our attention.
Thank you, Geeta.
Thank you, Geeta. So I think we have 5 responses.
Thank you, Yajna. That's really nice of you.
Yes, the session will be uploaded on YouTube, Yajna. As always, we are actually already live right now. So this recording will be on our Aspire for Her She Knows Money playlist on YouTube. Okay, thanks, Farisha. We can close the poll now. And I think with that, given that we are bang on time and it's always good, I wanted to say thank you, everybody, for joining. And Shilpa and Team NerdyBird, welcome to the team. And next week's session will be announced very soon. But next week, we're actually going to be talking about another exciting topic about investing in gold. And we will be back with our long-time partner, Womanista, and Neha Singh from Womanista. I think pretty much everybody knows her. So looking forward to that session and reconnecting with you all again next week. Thank you very much. And thanks, Tanvi. Thanks, Farisha, for help.
Thank you, Tanvi. Thank you, everyone. Thank you, Simran. It was
Thank you,
wonderful
everyone.
having this first session and excited for the upcoming sessions.